Have you ever wondered how to invest with no money down? An intriguing question, isn't it? Today we delve into the world of financial growth and independence through savvy investing strategies. We'll explore the teachings of Robert Kiyosaki, a mastermind who revolutionized the concept of investing with absolutely no money down. Imagine turning $0 into infinite returns, a prospect that might seem daunting yet tantalizingly attainable. So if you're intrigued about turning $0 into infinite returns, stay tuned. First, you need to grasp the concept of investing with no money down. Now, this might sound like a paradox. How can you invest with no money? Well, it's not that there's no money involved, it's that the money isn't yours. This idea is a cornerstone of Robert Kiyosaki's investment philosophy. So what exactly does no money down mean? It means leveraging other people's money to make investments. This could be a lender's money, a partner's money, or even a seller's money in certain cases. The key idea is that you're not using your own cash but rather someone else's to make an investment. Robert Kiyosaki, the author of the renowned book Rich Dad Poor Dad, has been a strong advocate of this concept. He believes that it's not about how much money you have but rather how you use your financial intelligence to make money work for you. His philosophy revolves around the idea that money is not the definitive factor in investing, but rather your knowledge, creativity, and ability to take calculated risks are. It's important to clarify that no money down doesn't mean you're getting something for nothing. It does require effort, strategic thinking, and a keen understanding of the financial landscape. You're essentially using your skills and knowledge as a form of currency, instead of cash. In this setup, the risk isn't entirely on you. It's shared among all parties involved. This mitigates your personal financial risk, and at the same time, opens up opportunities that may have been inaccessible if you were to invest with your own money. This concept is not a get-rich-quick scheme. It's a strategy that requires patience, diligence, and a solid understanding of investment principles. It's about making smart, strategic decisions that can lead to significant financial gains over time. Now that you understand the concept, let's move on to how you can make it work for you. This is where the real fun begins, as we delve into the practical aspects of no money down investing. It's about turning the theoretical into the practical, and the abstract into the tangible. Let's get started. The secret to investing with no money down lies in one word: leverage. Now, if you're scratching your head wondering what leverage is, don't worry, you're not alone. In the simplest terms, leverage is the strategy of using borrowed money to increase your potential return on investment. The idea is to use less of your own money and more of someone else's, often referred to as other people's money, or OPM. Let's break it down. Suppose you want to buy a car for $10,000 but you only have $5,000. You could go to a bank, get a loan for the remaining $5,000, and buy the car. That's leverage. You've used the bank's money to make up for what you didn't have, allowing you to make a purchase you couldn't have otherwise. But how does this translate to investments? Let's say you want to buy a rental property that costs $100,000 but again you only have $50,000. You could use the same strategy as the car and borrow the rest from a bank. Now, if that property appreciates in value to $150,000, you've made a $50,000 profit on your original $50,000 investment. That's a 100% return, all thanks to leverage. Leverage can be a powerful tool in your investment arsenal, especially when it comes to no money down investing. It allows you to make investments that you might not have been able to afford on your own, and can significantly boost your potential returns. But remember, with great power comes great responsibility. Leverage can amplify your gains, but it can also magnify your losses. If the value of your investment falls, you could end up owing more than you initially invested, so it's crucial to use leverage wisely and responsibly. Leverage, when used correctly, can open doors to opportunities that might have seemed out of reach. Not all debts are created equal. There's such a thing as good debt. Now I know what you're thinking, debt is debt, right? Well, that's not entirely true. Let's take a moment to distinguish between good debt and bad debt. Picture debt as a two-faced coin. On one side we have bad debt. This is the kind of debt that comes from purchasing things that depreciate in value over time. Think about those brand new sneakers you just had to have, or that shiny new car that loses value the moment you drive it off the lot. This is the type of debt that can keep you up at night. The kind that doesn't do you any favors in the long run. Now flip the coin. Here we find good debt. Good debt is a powerful tool. It's the type of debt incurred when you invest in something that has the potential to generate income or increase in value over time. This might be a mortgage for a rental property or a loan to kickstart a new business venture. Think of good debt as a kind of leverage. It's like planting a seed, nurturing it, and watching it grow into a fruitful tree. It's an investment in your future, a calculated risk that can pay off in a big way. And it's this kind of debt that is essential in no money down investing. Let's say you take out a mortgage to buy a rental property. Yes, you're in debt, but now you have a tangible asset. You can rent it out, generating a steady stream of income that not only covers your mortgage payments, but also provides a little extra on the side. Over time, the property itself may also increase in value, providing you with an additional return on your investment. So you see, not all debt is a four-letter word. When used wisely, good debt can be a powerful ally, a stepping stone on the path to financial freedom. Remember, good debt is your friend in this journey. No man is an island, especially in the world of investing. In the journey of turning $0 into infinite returns, one of the most vital resources you have at your disposal is people. Yes, you heard it right. People, your network. It's not just about the money you have, but about the relationships you build. Now let's clarify what we mean by network. A network isn't just a list of contacts in your phone or followers on your social media. It's about fostering meaningful connections with people who can contribute to your growth as an investor. It's about establishing relationships based on mutual trust, respect, and a shared vision. One of the biggest assets in your network? Mentors. Mentors are the lighthouses in the stormy sea of investing. They've sailed these waters before, they know where the hidden rocks are, they can guide you, offer advice, share their experiences, and help you avoid the common pitfalls. Look for mentors who have succeeded in the areas you're interested in, and don't hesitate to reach out to them. Partners too are vital. They can complement your skills, share the risk, and provide access to resources you might not have on your own. The right partner can turn a good investment into a great one. And let's not forget alliances. These are your peers, your fellow investors who are also navigating the same waters. They can offer fresh perspectives, new opportunities, and a sense of camaraderie in a sometimes challenging landscape. Lastly, remember the power of OPM, other people's money. This isn't about borrowing or taking advantage, but about leveraging relationships to access funding through partnerships, investors, or even crowdfunding. It's a win-win when you can offer a return on their investment while growing your own portfolio. In essence, building your network is about creating a community around you that supports your investment journey. It's about learning from each other, growing together, and creating opportunities that benefit all. So, remember, your network can be your net worth. Don't underestimate the value of the people around you. Build relationships, foster trust, share your vision, and watch as the doors to infinite returns swing wide open. Now let's delve into some strategies for no money down investing. The first strategy we're going to discuss is seller financing. This is where the seller of a property agrees to lend you the money to purchase their property. It's a win-win situation. You, as the investor, get the property without any initial investment, and the seller gets a steady stream of income over a period of time. It's like having your cake and eating it too, but remember, the icing on the cake is on the seller's terms. Next up is partnerships. If you're starting with zero, partnering with someone who has the financial resources can be a game changer. You bring the deal, they bring the dough. It's a symbiotic relationship where both parties benefit. You get to invest with no money down, and your partner gets a share of the profits. It's all about finding the right partner and structuring the partnership to benefit both parties. Lease options are another great strategy. This is where you lease a property with an option to buy it at a later date. You're essentially locking in the purchase price today, but you're not obligated to buy. If the property appreciates in value, you can exercise your option to buy and make a profit. If not, you can simply walk away. It's a low-risk strategy that gives you control over a property without any significant investment. Finally, there's wholesaling. This is where you find a great deal on a property, put it under contract, and then sell that contract to another investor for a profit. The beauty of wholesaling is that you don't need any money to put a property under contract. You're essentially playing the middleman, connecting sellers with buyers, and making a profit in the process. But remember, no money down doesn't mean no effort down. Each of these strategies requires knowledge, skills, and a lot of hustle. You'll need to educate yourself, build relationships, and develop a keen eye for spotting good deals. These strategies, when applied correctly, can help you kickstart your investment journey with no money down. Investing is not without risks, and no money down investing is no exception. The allure of building wealth without the need for upfront capital can be intoxicating, but it's essential to keep in mind that this strategy carries its own set of unique challenges. One of the most significant risks in no-money-down investing is over-leveraging. This happens when you borrow more than you can afford to repay, especially in a down market. While leveraging can amplify your profits during good times, it can also magnify your losses during downturns. The key to prevent over-leveraging lies in the fine balance of borrowing cautiously and investing wisely. Another risk factor lies in market volatility. The market is a living, breathing entity, constantly fluctuating due to a variety of factors like economic conditions, geopolitical events, and even public sentiment. As an investor, it's crucial to be prepared for these market swings and not to panic when they occur. The importance of due diligence cannot be understated. Before jumping into any investment, it's vital to do your homework. Research the market, understand the asset, scrutinize the deal, and ask plenty of questions. A well-informed decision is always better than a hasty one. Financial education is another crucial component of risk management. The more you know about finance and investing, the better equipped you are to make sound investment decisions. Whether it's understanding financial statements or learning about different investment strategies, ongoing education is a key part of mitigating investment risks. Risk management, in essence, is about preparing for the worst while hoping for the best. This involves diversifying your investments, setting realistic expectations, and having a clear exit strategy. By doing so, you can better navigate the ups and downs of the market without putting your financial health in jeopardy. In conclusion, no-money-down investing is not a risk-free endeavor. It requires a solid understanding of the market, a commitment to due diligence, and a robust risk management strategy. But with careful planning and a willingness to learn, you can mitigate these risks and increase your chances of success. Remember, knowledge is your best defense against risk. So you've learned the concept, the strategies, and the precautions. Let's take a moment to recap and really let these vital points sink in. Firstly, we delved into the concept of no-money-down investing. The idea, as radical as it seems, is to invest with zero capital, to start from nothing and yet generate returns, infinite returns. It's not a get-rich-quick scheme, not a magic trick, but a legitimate strategy, a path paved by successful investors like Robert Kiyosaki. We've explored the power of leverage, the key to no-money-down investing. It's about using other people's money to make your own, borrowing to invest, and amplifying your potential profits. But remember, leverage is a double-edged sword. It can magnify your gains, but it can also magnify your losses. Then there's the concept of good debt. Yes, not all debt is bad. Good debt is the one that puts money in your pocket, that helps you generate income. It's the debt you take on to invest in assets, not liabilities. We've also talked about the importance of building a strong network. Your network is your net worth. It's about knowing the right people, the ones who can provide you with the resources, the knowledge, the opportunities you need. It's about building relationships, because in the world of investing, you can't do it all on your own. And let's not forget the various strategies for no-money-down investing, from seller financing to lease options, from partnerships to wholesaling. Each strategy has its own advantages and challenges, and what works best for you depends on your specific situation. Lastly, we've discussed the risks and precautions. Investing, especially no-money-down investing, is not without risks. But with proper education, with careful risk management, you can mitigate these risks and increase your chances of success. In conclusion, no-money-down investing holds immense potential, but it's not something you jump into blindly. It requires education, networking, risk management. It requires strategy, patience, and perseverance. You have the knowledge. Now, it's time to take action and start your journey towards financial independence.